Everybody. This is Chris McKeffey, Head of National Sales here at BX Partners. Here today with Charles Helm, the Managing Director and Portfolio Manager at BH Asset Management. We're here today to talk about Charles's enhanced dividend strategy. So Charles, let's start with enhanced dividend. That might jump into somebody's mind as a high yield strategy, but that's not really what's going on here. Can you tell us a little bit about what your enhanced dividend strategy does?
Well, the enhanced dividend strategy is really a dividend growth strategy. So we look for companies with sustainable business models that are generating high free cash flow, able to compound at high rates of growth, and not particularly high dividend per se.
That's great. So there's a lot of different opportunities to manage money in different spaces. Why did you choose to manage this specific strategy?
Well, we found that over time, dividend strategies can underperform the market, particularly during periods of rising interest rates or inflation. And for that reason, we want to find companies that are not dependent on, for instance, high cost of capital or high fixed costs, where their rates of return are regulated, for instance, in utilities. So we generally avoid utilities in our strategy and find those companies that can compound and grow their cash flows and dividends regardless of the economic environment.
So there's a lot of different dividend strategies and value strategies that are available for advisors to use with their clients in the marketplace. You've delivered some really substantial outperformance versus the Russell 1000 value since inception over 10 years ago. But what is it that differentiates this strategy from the other dividend and value strategies that are available out there?
Well, our strategy definitely has some value characteristics, but we were able to match S&P performance since inception through 2017, and it was only since the liftoff and the hockey stick in growth stocks that we got left behind a little bit. And that process is now reversing, where we're seeing substantial outperformance versus growth benchmarks. The reason why we think that the dividend strategy has legs throughout this cycle, and particularly as value starts to mean revert, is because we have sustainable growing businesses. They're not just cyclicals. So you won't find a lot of materials in our portfolio. They're not tied to the housing cycle. So we did buy a lot of building products and even some home builders back at the bottom of the decline last year in March. But we don't own REITs, and we think that's a separate asset class that is best managed with a dedicated manager rather than trying to pick two or three REITs in the portfolio that are going to contribute. And the reason being that, as we saw during the great financial crisis, when you have capital constraint, those firms which do not pass most of the governance tests that any ESG manager would look at, tend to subordinate shareholder interests to the sponsor interests. And we prefer to have managements that are aligned with our investors, and therefore don't include REITs in our portfolios.
So that makes sense, which brings up the next question. We're entering, many people believe, into a period where we're likely to see higher interest rates because we are seeing kind of inflation pressures that we haven't seen in a long time. Now, traditionally, dividend-driven strategies would lag in periods of rising interest rates for various reasons. Why is it that an advisor would want to look to the enhanced dividend portfolio?
Well, our enhanced dividend portfolio is a dividend growth strategy. So while most of the dividend strategies out there are high yield or rely upon yield for a substantial portion of their benefit, ours is more of a growth focus, and that growth generates the additional dividends. So when you look at a company like AbbVie or a company like Apple or other growers in our portfolio, you find that those compound CAGR numbers are quite high, provide a lot of downside protection during choppy markets such as we're currently experiencing. And because of the value discount, where we hold many financial stocks, that is, we have a significant holding in banks that are benefiting from higher interest rates and a steepening yield curve, that we're able to negotiate these types of choppy environments better than the average man.
Thank you, Charles. We appreciate you spending some time to get on with us today and explain to advisors exactly what, why, and how the enhanced dividend strategy works. You've had tremendous success over time running this portfolio. And for everybody out there, please get in touch with us for more information about this strategy.